We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy. Thanks for joining me today, Lyn. It's great to have you back.
Thanks for having me back. Always happy to be here.
So, Lyn, a topic that I was thinking about this week, in preparation for having you on the show, was I wanted to get your take on fiscal dominance. It's something that I spoke recently with Luke Groman about, and also Matthew Piepenburg, and it was on my mind. Considering your real macro view of these things, and thankfully, when I started my research, turns out you were already writing about it. So I'd like to kind of start by talking about how, let's say, fiscal policy that we're seeing this decade will be driving inflation and how that will ultimately lead, obviously, to more treasury issuance to cover that interest cost.
Yeah, it's a good set of questions. And one reason I've been focusing on this a lot lately is if I go back many years to 2016, 2017, one of the things that made me more interested in focusing on macro versus equities, I cover a lot of equities, but my historical focus on investing was, value investing or growth at a reasonable price investing, kind of analyzing equities. And the reason I began emphasizing macro more is because we started to get an unusual phenomenon. So normally budget deficits in the United States are highly correlated with the unemployment rate. So low unemployment, smaller deficits, higher unemployment, higher deficits. And in that 2016-27 timeframe, we started to see a decoupling. So the unemployment rate was going down, but deficits, which had been going down as a percentage of GDP, began widening. And when you looked into why, it was largely a demographics issue. So as the top-heavy entitlement programs, which were in place, as the very large baby boomer generation began entering retirement in size, we started to get this divergence where you have large deficits even when you have low unemployment. And of course, they blow out during an entity like an aspect like COVID, like a period like that. And so the early signs of fiscal dominance began back then. Of course, it was a very small thing, but it's showing the initial trend change. And basically, in my view, that said, okay, some of these things that people have talked about for decades that they were often too early on are actually starting to materialize. And it'll still take time, but they start having to be discussed and analyzed. Mm-hmm. And I think what we're seeing this year is a more tangible example of fiscal dominance. So for people who haven't followed the topic, fiscal dominance is basically when a government runs such large deficits and has such high public debts that they can in some ways override monetary policy, that they become a bigger force. And so if you have an environment of low deficits and low public debt to GDP, then generally speaking, monetary policy is going to have a bigger role to play than differences in fiscal policy. Whereas if you have an environment of high deficits and high debts, especially if there's no clear path, like a political path to fix those, and that therefore they're expected to be around for a long time, even if it's a problem, then that fiscal policy can override monetary policy. And so basically the way that monetary systems tend to get reset or rebuilt is basically you have a system, it's incentivized to run large and large deficits over time. And eventually all those deficits accumulate into very high debt as a percentage of GDP ratios. And so for the past 40 years, and this is why the problem's kind of happening now. So for the past 40 years, we've had steadily rising debt to GDP, 30%, in the beginning of 1980. So 30% debt to GDP up to, call it 130% of debt to GDP. But that was offset by structurally declining interest rates for 40 years. And so the interest expense was never really a problem, and it was kind of held in check. The problem is that after 40 years, as you run into zero, and now we bounced off zero, and if we're going flat to up now in terms of interest rates, those ongoing deficits and debt as a percentage of GDP are going to mean that interest expense begins growing a lot quicker than we're used to. Money that's pouring into the economy, that's increased deficits. So you get deficits beget more and more deficits. And generally speaking, that's how these systems end. And of course, every end is a beginning. So that's how these systems tend to get recapitalized, reset, however you want to call it. Generally, these big monetary, macro, geopolitical things happen around these environments. So that's why I think fiscal dominance is such an important thing to be covering right now. And then in the intermediate term, what it's doing is it's pushing back a possible recession, or it already has pushed back a possible recession, because it's essentially a type of stimulus. So, for example, if we look at how much deficits were being run during the Great Recession of 2008, 2009, and you look at how much deficits they're running right now before a recession, it's actually like you're almost like pre-stimulating before the recession. And so that's kind of the environment we find ourselves in.
Mhm. There's a lot to kind of break apart there, Lyn, and I'd like to go through a lot of it piece by piece here. But maybe a good place to start is asking, what are the two causes of inflation, and how should we think about breaking them apart?
Right. So that question could be answered in a few ways, because if you look at if you define it as price inflation, right? So on one hand, you have supply of money changing. That's a key variable. And then the other side is various types of productivity or supply side limitations that make those increased money supply actually result in higher prices. So for example, no matter, like a television has gotten cheaper over the past 20 years for a similar size and quality, despite the fact that money printing keeps happening because the technology has been so deflationary, right? So that those are the two main variables to consider. And then when we answer the question another way, what are the two main sources of money creation then? So one of the main sources is bank lending. So when banks in a fractional reserve system, when they lend money, they create new deposits. They lever up the broad money supply relative to the base money supply, and they create more broad money. And that's spendable money that we have, and that can so periods of elevated credit creation, bank lending, can result in more money out in the system, more deposits chasing similar amounts of goods and services, and so you can get a lot of price growth. Um, During the 1970s was kind of the key period of that. If you go back from the present day all the way to the second half of the 1800s, the period of fastest bank lending growth was the 1970s. And that was in large part because the baby boomer generation, which was, the early ones were born in the late 1940s, they began entering their 20s and began entering their family creation, home buying years. And one of the biggest sources of credit creation is mortgages. And so you had a lot of building, construction, credit creation. And of course, you also ran into supply constraints. U.S. oil production peaked in 1970. We became more reliant on imports, and so that was a supply constraint that our elevated money supply creation ran into. So that's basically how you'd summarize the 70s inflation. The other type of money creation is large monetized fiscal deficits. So even if banks aren't lending much, if the government just issues a ton of bonds and then gives everyone $1,000 or $5,000 and then tells its central bank to create more base money and buy those bonds, whether it's on the secondary market or not, that increases the amount of broad money supply and circulation again. And so in the 1940s, for example, which was just as inflationary as the 1970s, it was not because of a demographics bulge. In fact, demographics were pretty weak. It was not because of bank lending. Banks were barely lending at all. It was because the United States was running absolutely enormous fiscal deficits to fight the war. And that money meant soldier salaries, buying commodities, buying manufacturing facilities. When the soldiers came home, they put them through college and technical school and gave them mortgage assistance. And this was just a massive amount of new money creation, which was very inflationary. And so basically, when you contrast the 70s and the 40s, you get two very different understandings of how money creation can happen, and they're both true. And so you have to, basically, when we're analyzing inflation, we look at what is the source of new money supply, and then what sort of real world constraints is that new money supply running into?
Yeah, I mean, the example of looking at the 1940s inflationary picture versus the 1970s, as you wrote in your article, I think it was your July monthly newsletter. It's just so interesting to really break it apart like that, because it really highlights the idea that we need very different toolkits to fight both of those different types of inflation. which I want to get to the situation we're facing today, but lingering on those examples a little bit, what kind of different tools can we use, let's say in that 1940s inflationary picture versus the 1970s inflationary picture? Which tools are more effective in those times?
Sure. So one of the tools that applies to both is trying to find ways to fix the supply side, right? So if there's a war, end the war, right? Or you complete the war one way or another. If there's an oil supply shortage, find a way to get those oil supply lines open, or find ways to incentivize more oil production. So basically fixing some of those bottlenecks or things that are damaging productivity is one that's always applicable. The other option, the other side of it, of course, is then addressing what is causing the elevated rate of money supply growth, and how can you slow it down? And so if the answer is large fiscal deficits are responsible for the majority of money supply growth, then the answer is to reduce the deficit spending. Could be raising taxes, could be cutting spending. It depends on where the source of the problem is. But basically, that system needs to be less about financing deficits with money printing and more about sustainability. If the answer is elevated bank lending is causing it, then you want to find ways to slow down bank lending. And so that generally, that's where monetary policy tends to be more effective, by raising interest rates. So when people think of inflation, they often think of the 70s. That's the default mental model that people have. And they also then, by definition, assume that high interest rates are the primary tool to combat high inflation because it worked in the 70s. And the challenge there is that you have to kind of address what is the problem and what is your solution doing. So what exactly do high interest rates do? They do a couple things. One is, from a global funds flow perspective, they entice foreigners to want to hold your currency, and they entice locals to want to hold your currency, not go elsewhere, right? So if Turkish lira is inflating at 80% a year, but its interest rates are 20% a year, it's not desirable for either Turkish people or international people to hold it. And so Turkish people will try to get out of it. No foreigners will want to buy it, and the currency will weaken. Imports will get more expensive, and that's inflationary, right? So higher interest rates, or like higher real interest rates, help to entice people to want to hold that money. So that's number one. Number two is higher interest rates can slow down bank lending because it makes it less attractive for borrowers to borrow money. Now, there's not a perfect correlation there. In fact, if you get too low interest rates, you can ironically slow down bank lending because banks don't want to lend because they're not compensated to it. The risk is too much relative to their gains. So it's not a linear perspective. But in general, if you have an inflationary environment, higher interest rates are one of the tools available to try to slow down that bank lending. Now, of course, the problem materializes if you're trying to use the wrong tool for the wrong situation. So if the problem is you have very large federal deficits that's pouring more money into the economy, and you've done that long enough, you also have very high public debts as a percentage of GDP. The problem is that when you raise interest rates, if excessive bank lending wasn't the problem to begin with, it's only going to have a moderate effect on slowing down inflation because bank lending wasn't the source of most of the new money supply creation anyway in that particular environment. And two, it's actually going to increase the federal deficits because that 130% debt to GDP is now paying much, much higher interest rates, which flows into the private sector, right? That's flowing into retirees' bank accounts. That's flowing into banks and insurance companies. That's flowing into offshore where they can buy more commodities with it. Basically, this is a much larger deficit situation. And so the challenge is basically using the wrong tool for the wrong job, or trying to basically address a problem by suppressing something else. So the reason that even the wrong tool can work sometimes is if you have a private sector money creation and a public sector money creation, and the public sector is causing too much of it, and you raise rates, well, depending on how the timing works out, it might work for a period of time because you could suppress private sector to below normal so that it offsets some of the fact that public sector is above normal. But of course, that only works for a period of time. And so I think that's what we find ourselves in now. Basically, the 2020s are, and I've been arguing this since 2020, is that this whole period looks a lot more like the 1940s. We don't have excessive bank lending. Our bank lending rate is not above normal. But what's above normal, both pre-COVID and then during COVID and then post-COVID, is very large federal deficits, and then very high public debt to GDP ratios, so that increases in interest rates in some ways do suppress inflation because they can slow down commercial real estate, they can slow down tech VC. They do put some downward pressure on inflation, but at the same time, they're also exacerbating the fiscal deficits, and therefore, after a period of absorption, they risk actually exacerbating inflation in the long run.
Do you think that it's also useful to break the idea of inflation apart into two separate categories? Let's call it CPI, or product inflation, versus, let's say, the Austrian definition of inflation, that being money supply.
Yeah, in articles I've written about inflation over the years, I often, because people will talk past each other with different definitions, so I just lay out the definitions ahead of time. I'll say, well, there's price inflation of a agreed upon basket of goods and services, and then at the root layer, there's growth or changes in the money supply. And so I think both are worth discussing, because as we've talked about in this interview so far, money supply changes are a major variable for changes in price levels, but not the only variable. So these are two separate concepts to keep track of, and they both kind of share the word inflation. And so I think you can call it money supply inflation, you can call it asset price inflation, you can call it consumer price inflation. I think it's important just to define your terms. And even when you look at CPI, the challenge is that the basket by definition is artificial. And so, like in the recent book I wrote, I one of the things I did was look back in history at all these different inflation rates for different categories. And generally you see a pattern. So let's say in the United States, round numbers, over the past century, you have 7% average annual money supply growth. The most scarce things in the world, like paintings from long dead famous artists or waterfront property, things that we literally just cannot create more supply of, will generally increase at roughly that rate. That's roughly the rate that they increase that in price, because you get a 1-to-1 correlation, money supply growth, and the prices of those goods. Then the next step down is you take things that are energy intensive and scarce, but we can still make more of them. Things like gold, oil, a typical house, like a median house rather than a waterfront property. Things that are tangible and that have a real world resource cost, they tend to increase at maybe 3 to 5% per year on average over the long run if money supply is going up 7%, because we are getting more productive and better at making them. But not enough to offset all that money supply growth, and that those things tend to be above the official rate of CPI growth. And then you have things like then you have the CPI itself, which is below all those things. And then you have this like deflationary long tail of stuff that we've gotten way better at making, like electronics or textiles. Things that we've industrialized or outsourced so much that these are in some cases outright deflationary. And that's what weighs down the CPI basket relative to those scarcer types of goods and services. So I think if you're a consumer perspective, one thing you can do is look at the money supply growth. But if you want to check your math on that, one thing is to look at the long run growth rate of scarce things you want to buy, right? A desirable property, energy, things that are truly scarce. And that's really the inflation rate that you're competing with.
Mm-hmm. I find it interesting to also think about the different ways in which, let's say, $1 trillion put into the economy would have on different, let's say, price good inflation rates, right? If you gave, I think your example was $5,000 to the top 200 million people versus giving, what was it, $1 billion to the top 100 wealthiest people, those are going to have very different effects within the economy, right?
Yeah, because that's where you get kind of a difference between consumer price inflation and asset price inflation. So, if you give Warren Buffett another $1 billion, what is he going to buy with it? right? He already has everything he wants to buy for his own self. He already buys those things. He's not going to buy more food. He's not going to buy. Instead, he's going to buy more equities. Is ultimately what he's going to buy, right? If you were to distribute $1 trillion to the 100 richest people in the country, they might buy some high-end luxury goods, like we might see some yacht price inflation. But what they're primarily going to buy, because they already have their needs met, is more financial assets. They're going to go out and buy Manhattan real estate. They're going to buy equities. They're going to buy Rolexes, or whatever the case, whatever they might buy. That's the type of thing. So you're going to likely get asset price inflation. On the other hand, if you were to give $1,000 to everyone in let's say you take $1 trillion and you give it, of several $1,000s each to the bottom 50% of society, it's still the same amount of money supply growth, but that group is going to buy very different things, right? Because their expenses are constrained by their income, right? There's more things they would like to consume, but they're unable to because of their income. And so if they do get that extra income, they're going to go out and they're going to travel more. They're going to eat at more restaurants. They're going to go on vacation. They're going to
buy another car.
Yeah, they're going to buy another car. They're going to buy another TV. They're going to, maybe if they were eating rice and beans, they're going to go buy some chicken. They're going to go buy some beef. They're going to use more energy. And so that's more likely to translate into consumer price inflation. Basically, these are just whatever money people have. As they get more money, it's going to inflate the price of things that they themselves buy, which obviously differs partially based on personal preference, but in large part then based on how much wealth someone already has.
So, Lyn, going back to, let's say, the picture that we're facing today, are there any analogs in history on, let's say, how high our fiscal deficit is as a percentage of GDP combined with, let's say, new money creation and money growth?
It's most comparable to the 1940s. The 1940s peak World War was bigger as a percentage of GDP deficits than even the peak of COVID. That's the high watermark for American history. Same thing is true for money supply growth. Basically, the numbers we've seen in recent years have been unmatched, including the 70s in year-over-year terms, and only going back to the 40s do you find a bigger number. Now, what makes it different than the 40s is that in the 1940s, it was extreme, but it had an ending, which was the war ending. And so you had this extreme spending environment, but as the war ended, they pivoted to a period of austerity, and they were very productive, and they still had a generally young society. What makes it hard now is that there's no end in sight to how we're pivoting out of. So our numbers are not as extreme as the 1940s, but there's no clear path to ending this, right? Especially in polarized American politics, it's unlikely to either meaningfully cut Social Security, meaningfully cut Medicare, meaningfully cut military, or meaningfully raise taxes. And then what complicates it is that when you have that high debt to GDP, even if you do actually reduce the deficit, the problem is that if the economy is so financialized, you also likely reduce GDP and reduce tax revenue. So, for example, if we slow down the economy, if you slow down property speculation, if we slow down, the stock market goes sideways instead of up, a lot of actually income taxation is indexed to things like executive stock options and just overall financial asset performance. So ironically, if you try to get more austere, you hurt your own tax base, and it's almost self-defeating. And so generally what you see in these environments is basically the debt's too high. It's going to get defaulted on one way or another. So in the 1940s, for example, they said, well, we're going to do yield curve control. Inflation averaged 6% for a decade. They held interest rates at 0 to 2.5% for a decade. And if you were holding cash or bonds, you just got killed. And if you were holding stocks or real estate, you did better. But of course, that translated into elevated taxes that you still got clipped by generally. And so generally in these types of environments, what happens is some degree of, restructuring, devaluation. Basically, the debt does not get paid back in full purchasing power as originally issued. So that's number one. And then you'd need some sort of austerity pivot. You need a way to basically stop the ongoing blood loss and stabilize it, which is hard to do in this type of political environment.
So why is raising interest rates when, let's say, federal debt is over 100% GDP so detrimental? And does this really bring us back to the concept of fiscal dominance?
So in the 1970s, you had federal debt as 30% of GDP, and most of the money creation was from bank lending. So by increasing interest rates, although it does increase the federal interest expense and deficits, the negative impact to bank lending is bigger,
Mhm.
right? And so that is generally disinflationary. The problem is that if bank lending is like moderate or mild, and federal debt is 130% of GDP, the challenge is that beyond a certain point, as you raise interest rates, while it does put some downward pressure on bank lending, and that's disinflationary, the impact to that 130% debt to GDP is larger than that negative impact you're having on bank lending. And we can even go a step further and say, okay, well, look at Japan. Japan's like 250% debt to GDP, and bank lending's negligible. So if you raise interest rates, you're not going to impact bank lending that much, but you're going to completely blow out the deficit. And so as you kind of go along this road, money's like interest rates start having unintended consequences. So when we're in an environment like the 1970s with low federal debt to GDP and a lot of bank lending, money supply and interest rates work intuitively. Basically, they work how we imagine them to. You raise interest rates, it slows down bank lending, it slows down inflation. Makes sense. That's our mental model.
It,
The
it would
problem is that,
almost be like they work more directly, you could say almost.
yeah, they work directly as intended. Whereas when you have that inverse situation where so much debt is accumulated at the public level and deficits are not controlled, you've gone through the looking glass. You're like everything's flipped upside down, everything's reversed. And so raising interest rates can actually have unintended consequences. And beyond a certain point is either neutral for inflation, like it might have equal negative impact on inflation versus inflating something else. And if you get as extreme as, say, Japan, then it can outright be more inflationary. And another thing to consider is to what extent a society has locked in fixed long-term interest rates. So, for example, in the United States, during this low interest rate environment, homeowners locked in 30-year fixed rate mortgages. Corporations locked in very long duration, low fixed rate debt. And so let's take an example like ExxonMobil. ExxonMobil has a great credit rating, so they've been able to borrow very cheaply and at very long durations. They have, rough numbers, say 40 billion in debt and 30 billion in cash, right? But ironically, that cash is higher yielding than their debt now.
Mhm.
They've almost like made themselves a bank in addition to an oil company where they've issued all these like liabilities. Their liabilities are only rolling over. They're maturing and having to get refinanced at very low rates. So even though the higher interest rates are maybe not great for them, it's really not that impactful. Um, whereas it's impacting the federal government a lot more. It's shorter duration debt on average. And of course, it impacts interest rate sensitive areas significantly. So commercial real estate, that's also short duration debt. So that is, it's deflationary for commercial real estate. It's having that consequence. It negatively impacts junk rated companies because again, lots of debt, short duration. So they run into that financing risk. And it also impacts unprofitable tech companies, whether it's publicly traded ones or ones that are still in the venture capital phase, because they're reliant on low discount rates, very high equity valuations, and constantly issuing new equity. And so in a harder money environment, higher rates, that equity is less enticing. And is generally going to be bought at a lower valuation. So it slows down the growth and the kind of the malinvestment that can go on in that unprofitable tech space. So the higher rates, it's not to say that it's not impacting things, it's impacting certain parts of the market, but it's almost like you have two different markets now.
Mhm.
You have companies that really don't care about interest rates and companies that do. And then also for the consumer, I mean, if you, let's say you're a 65-year-old upper middle class retiree, right? And you've either got a house paid off or you've got a lingering fixed rate mortgage that you've locked in, um, and your bonds are paying a higher interest rate now. So you're going to go out and eat. You're going to go travel. You're going to spend on these things. That's why we see a lot of strength out of the services sector, because this increased money is pouring into the wealthy, the upper middle class, and kind of going down there. And so things that they buy are still doing pretty well.
Yeah, it's interesting to think about that corner of the stimulatory effect that is having. But you brought up the example of mortgages and how raising rates can affect countries differently. So can we also, let's say, contrast Australia or even Canada with the US?
Yeah, so countries like Australia and there's this big spectrum here for different countries in terms of how much uh, personal debt they have as a percentage of GDP, and then what percent of them have long fixed rate debt versus variable rate debt.
Mhm.
And on the extreme end of the spectrum are Australia and the United States. So in the United States, we've got almost all fixed rate debt at the consumer level. So the fixed rate mortgages dominate, and the more variable types of interest, things like credit cards, they tend to be much smaller segments of overall public debt than this big existing base of fixed rate debt. In addition, our corporations, because we have very robust capital markets, they tend to borrow with bonds. So they lock in these long fixed rate obligations. When you look at Australia, their households have very high public debt to GDP because they have a very expensive real estate market and it's highly levered. But unlike the United States, those are more variable rate, almost all of them, like a very big percentage of them. And so when the Bank of Australia raises interest rates, that negatively impacts consumers a lot more quickly than when the Federal Reserve raises interest rates. And so that's the big contrast. In addition, a lot of markets, including Europe, for example, let's take Europe. They, in general, if you look at even large and medium-sized companies, they often use a lot of bank lending. Their bond markets are less deep than American bond markets. So the average kind of mid-sized company there is more reliant on banks than bonds. And so you generally get that less of that long duration fixed aspect as well. So to the extent that higher interest rates slow down the private sector will in large part depend on what type of debt structures they have.
Yeah, it's interesting. Just as a bit of an anecdote, in Canada, I've seen that there are several, let's say, variable rate mortgage companies that have taken to extending the term of the mortgage instead of the monthly payment. So I saw an example that there were some of these mortgages are out to like 75, 80 years now. And that just, blows my mind that there are debtors willing to extend that type of debt over that kind of time horizon.
Yeah, there's always tools to kind of kick the can down the road.
Mhm.
And the problem is when you reach the limits. So I talked before about how higher and higher debt as a percentage of GDP in the United States was offset by lower and lower interest rates for 40 years. That's been this kind of offset.
Mhm.
One of the ways to keep interest expense in track, in check, is to extend that duration. But of course, that only makes sense up to a certain point until it becomes, it makes no sense to extend it any further. Just from a lender perspective, it just, if a consumer's debt is longer than their lifetime, it doesn't make sense unless you're in an environment where you can like pass it on to their heirs or something. Like it's just the economics of that lending make less sense. So the problem occurs generally, these problems get kicked down the road more and more and more until your various offsets, whether it's lower interest rates or whether it's extended durations, when those can't really be extended anymore, either because you've run into zero or you've extended it to like the human lifetime, there's really no more room to run. And so that's when you generally get the more acute problems.
Mhm. So, Lyn, as we're thinking about the idea of duration and interest expense here, I think it's important to kind of highlight in the understanding of this the federal expense, let's say, for every 1% increase in interest rate that results in $320 billion worth of annual interest expense on that $32 trillion federal debt. But I guess the piece that I want to understand here is that debt doesn't all have the same maturity, correct? So we don't end up actually, let's say, incurring that whole $320 billion worth of interest expense per year for every percent increase all at the same time. Is that correct?
Yeah, and this is part of the reason why monetary policy comes with a lag, both the private sector and the public sector, that it's not as though all debts mature right away. And in the United States case, a very large percentage of their of their debts are actually very short duration, under 2 years or so. And so a lot of that is already refinanced. But then the other big chunk of it is these, various layers of long term. On average, US debt is something like 6 years of duration, but it's very front loaded with a long tail that stretches out 30 years. And so, if you do the math, for example, 32 trillion in debt, if the average was 5% interest, you'd have $1.6 trillion a year in interest expense. And so the question is, what right now we have less than $1 trillion, just under $1 trillion. And the question is why? It's because even though interest rates have gone up to over 5%, not all of that debt has matured and gotten refinanced at that 5%. So even if the Federal Reserve never increase rates again, if they were to like hold rates here longer, the interest expense would trend from just under $1 trillion towards 1.6 trillion. And of course, because we're still running like $2 trillion deficits a year, that $32 trillion in debt is going to become $40 trillion in debt, which means at an average of 5%, you're talking about $2 trillion a year in interest expense. So that's the challenge when you run out of road for offsetting higher debts and deficits with lower interest rates.
Yeah, and I mean, without raising GDP and productivity, there's no good end to that, right?
Yes, and then the challenge is that even if you do, let's say, for example, that AI gives us a huge period of productivity boost.
Mm-hmm.
What that means is that when you look at a basket of goods like CPI, you could have a bigger than normal disconnect between money supply growth and price increases. The problem, though, is that, like we talked about before, is AI going to affect the productivity of making new Da Vinci paintings? No. Is it going to affect the productivity of making new waterfront property? Probably not. Is it going to dramatically affect gold or oil? Maybe around the margins, maybe our scanning for deposits get better. Maybe the commodity company's administrative overhead is a little bit streamlined, right? But unless AI solves some massive physics breakthroughs or something, like until we get to that point, it doesn't meaningfully impact our ability to build bridges, mine gold, produce oil, things like that. So basically, if you have a period of rapid money supply growth but a lot of productivity increases, you just get those cheaper things like software and stuff like that, and administrative stuff that stays pretty cheap. But then those truly scarce things keep going up. So if you think you're going to encounter an environment like that, which I generally do, it's basically ongoing productivity, offset. I think on one hand, AI is going to give us more productivity, or just technology changes in general, but some degree of deglobalization or geopolitical frictions that takes away from some productivity. To the extent that we have various wars, that's generally anti-productive. So we'll see how productivity goes. But if you have that period of elevated money supply growth, and you have that period of significant productivity growth, then what you want to own are the scarcest assets. You want to own things like gold, Bitcoin, high valued properties, are like whatever, or the highest quality equities. You want to own things that AI is not going to make more of, to put it kind of lightly. And the other thing to keep track of is generally money supply growth. So right now, even though we have very large deficits, we don't have very large money supply growth, unlike the past few years. And that's because the Federal Reserve is doing quantitative tightening. They're doing their best to slow down money supply growth. The challenge, of course, is that when you run these deficits this large, the Federal Reserve can only do quantitative tightening for so long until they'd have to stop doing it and maybe even go back to gradually expanding their balance sheet. And so, it's not, when I talk about money supply growth, I'm not talking about the next 6 months. I'm talking about like basically this decade, that we're on a path towards structurally large fiscal deficits and an inability of the Federal Reserve to tighten to a sufficient degree. And that's generally what the definition of fiscal dominance is, which is that the central bank's options become constrained by what the sovereign government's doing. And an example of that is that, in September 2022, the UK sovereign bond market broke. And so the Bank of England, they literally had a speech scheduled about balance sheet reduction. and they had to cancel it and reinitiate QE while inflation was 10% year over year to support the sovereign bond market.
Right.
Now, that was a somewhat temporary problem. So they were able to eventually get back to balance sheet reduction after they kind of fixed that liquidity issue. But the problem is the bigger and more structural that problem is. You can imagine we were running 10, 15% debt to GDP deficits every year, right? And the Federal Reserve, the central banks will never let their sovereign bond market just default and break. I mean, it's their own currency. Every bank would just go insolvent. So their options for how to manage their balance sheet get constrained by what the sovereign government's doing, and that's fiscal dominance.
Mm-hmm. Yeah, I mean, it really just shows us or I guess re-highlights the path that we're on, the constraint that the Federal Reserve really has, and the ability of the central bank to really have its intended effect with the tools that it has. One of the other points that you made earlier was that the path that they're taking, or the road that they have embarked upon by raising interest rates and reducing their balance sheet, has in a lot of ways delayed a recession. So can you explain to us how that is working at this point?
Right. So, when the Federal Reserve initially started setting on their policy of tightening in early 2022, in spring, I talked about recession in my newsletters. And, that whole year was indeed terrible for asset prices. And it was most economic rate of change indicators were slowing down all throughout 2022. Now, what started to change in early 2023, and to some extent in very late 2022, was that this ongoing tightening by the Federal Reserve, even though it had killed certain industries, or at least killed certain asset prices and certain types of inflation, the fact that it was now resulting in larger deficits because of that heightened interest expense. Basically, the federal government debt had given enough time to start maturing and getting refinanced at these higher rates. And the Federal Reserve's operating at a loss. They're the opposite of ExxonMobil. ExxonMobil's assets pay higher interest rates than their liabilities. The Federal Reserve is paying higher interest rates on its liabilities than it is earning on its assets, and that's money that's pouring into the economy. And so, as these various liquidity effects started to actually impact it, we got this weird environment where, so throughout 2022, the deficit was shrinking as a percentage of GDP. We had fiscal contraction, but in 2023, it started widening again. And that's in large part because of interest expense. So by pushing down asset prices, at least for temporarily, that hurt tax revenue. And then it also increased interest expense. So both on the budget, on the revenue side and the expenditure side of the federal government, it increased deficits. And generally speaking, when you have a recession, governments increase their deficits, either because their tax revenue collapses, but they keep spending, or because they also increase spending as a form of stimulus. Now, before this recession could even materialize, we're running, $1.5 trillion or $2 trillion deficits, like, 6 to 8% of GDP deficits before the recession's even here. And that actually, it's kind of challenging to have a recession when you're pre-stimulating to that degree. Mm-hmm. Now, you can still have one, especially in real terms. That's how recessions are defined, but it extends the negative impact you need from the private sector in order to have a recession. It keeps kind of pushing the can down the road. It makes it so that inflation falls a little bit less quickly than we think, and it makes it a recession is kind of pushed out for a period of time. And so that's kind of where we find ourselves right now, where monetary policy is trying to be very tight. And like I said before, in certain areas, it certainly is. Commercial real estate, junk-rated companies, unprofitable tech companies. These have been a truly, disinflationary, deflationary type of area, whereas services, investment grade companies, upper middle class consumers, these have generally not been heavily impacted, and if anything, are that interest expense and the overall large federal deficits are flowing to them, and so they're able to keep spending, keep consuming, and we've had various inflationary offsets, like oil was very expensive, so we drew down the strategic petroleum reserve. China has been slow to come out of its kind of COVID slump. They're actually doing the opposite of us, where they're their monetary easing is easier than ours, but they have a very tight fiscal situation. They're not stimulating fiscally, which is the more powerful tool. And so China is pretty slow right now in terms of consumption and things like that. So that's a disinflationary pressure for the world. In addition, China helped Iran get more oil to market, around sanctions and things like that. So the combination of drawing down the SPR, getting Iranian oil to market, and kind of curtailing overall Chinese demand, that has been a truly disinflationary force, especially for energy markets, at least temporarily. The problem is that I think a lot of that is done now. And so as this ongoing thing continues, we're seeing a re-acceleration of some energy inflation. And so when you're not offsetting these deficits with something else, that's when you can get a bottom in inflation, and you can actually start to roll up in inflation. So I think that's something to monitor going forward. So we basically have these two very powerful forces. And instead of thinking in Boolean terms of recession or no recession, I think we have to be very specific on the industries we're talking about. So commercial real estate recession, absolutely. Recession in restaurants, maybe not. Maybe it's a no recession in restaurants. Is it a recession for investment grade companies that are earning more interest on their cash than their debt for like in the first time in modern history? They're not complaining in this environment, right? So I think that we have to be very specific with the industries we consider when we talk about recession. And then of course, whether or not it becomes a true recession is when you add that all up, is that, are we reducing our number of employees? Are we reducing our real GDP or not? So far the answer has been no, although of course this type of data is subject to revision. We could even be in a mild recession right now, and we won't know until months from now. Like if you go back to the Great Recession, they were already in recession for like part of 2007, and they didn't know it yet until afterwards. That's generally how recessions work. So looking at the data we have available, we're not in a recession, but it could be revised. But basically, we clearly have very weak areas of the economy, and we have other areas of the economy that are just totally shrugging it off.
Yeah. You bring up the idea of China reopening after the COVID lockdown that they had implemented that was very strict. And of course, it was speculated that them opening back up was going to have this huge inflationary effect and really bring demand for energy and all kinds of commodities back online. But, since the pandemic, one of the big ideas that has been thrown around is the idea of reshoring manufacturing to the US and lessening our dependence on China and the rest of the world. How can this also drive more inflation?
Well, so I think first of all, that's going to be a very slow process. We've seen from recent bills, there are various incentives there to basically reshore key industries. And so if you look at domestic construction expenditure on manufacturing facilities, it's basically doubled compared to a normal baseline. So instead of spending $100 billion a year, we're spending $200 billion a year. The challenge is that that's offsetting a multi-trillion-dollar industrial base that we rely on in China, right? So it's not like 1 year of extra $100 billion is going to reshore everything. This is a multi-trillion-dollar endeavor to the extent that we want to reshore certain things. Part of the deflationary offset we've had in the past 30 years has been this globalization. So they fire an American worker and they hire a Chinese worker, right? And that person does the same job for a quarter of the wage, and that has been a offset from a corporate perspective. So corporate margins are near record highs because they've reduced their cost basis. And from a consumer perspective, it's been somewhat bifurcated, because if you're one of those workers that got fired, or that maybe didn't get fired, but it's hard for you to ask for wages because the threat of outsourcing is always there. So your negotiating power is now limited. Your overall consumption's been constrained. Whereas if you work in healthcare or government or finance or tech, you've not really been impacted by that. And so you're still able to expend, and you're getting the benefits of cheaper goods and services. So I think as if the world becomes a less, if it becomes a more polarized space, and I think one way to describe it is over the past several decades, we've sacrificed some degree of resiliency for greater efficiency. So in theory, if you say, okay, China makes all the industrial stuff and Brazil makes all the food and Europe, we all go to vacation in Europe and America makes all the social media companies. And if you it's highly specialized like that, it makes the world more efficient. But of course, once some of these countries don't like each other anymore, one country says, wait, how am I going to get my food? Another country says, how am I going to get my industrial components? Another company says, how am I going to get my tech? And then so that's where they say, okay, we have to be less efficient and more in-house diversified, right? But when you then go back towards a period of less efficiency and more resiliency, shorter, more local supply chains, more redundancy of supply chains, that's generally more inflationary because when we go back to the prior discussion, one side of it is money supply growth and the other side is overall productivity. And generally when you have either more expensive supply chains or duplication of supply chains to try to boost your resiliency, that comes at a greater cost.
And of course, there's a couple factors that you also wrote about that really, let's say, stand in the way of reshoring quickly. And that's, let's say, the availability of skilled labor, and also, let's say, the availability of not necessarily even cheap energy, but just energy in general. If, let's say, your grid and your energy production is matched to your demands at this point, somehow you're going to have to be able to supply the energy for that manufacturing facility as well, right?
Yeah, if we want to reshore things, it's not as simple as just building a couple manufacturing facilities and say, okay, we've reshored everything now.
Mhm.
The reason this is a multi-trillion-dollar endeavor is, so if you look at the United States energy consumption or energy production, I should say. So let's say electricity production, right, which is what all manufacturing facilities use. It basically flatlined over the past 2 decades. Whereas China, which is where we outsource a lot of our manufacturing to, their electricity production is immense. It's like twice the United States. They've got this huge, massive power generation. And when you actually dig into the nuts and bolts of that, for them it's a lot of coal, but then it's even like water constraints. So basically, coal plants, nuclear plants, all these types of power generation facilities need a lot of water for cooling,
Mhm.
right? So they even sometimes they literally have power outages because they ran out of like water to cool, and they had to like shut certain things. Yeah, there's a lot of like details like that that basically form the core of a manufacturing base, an industrial base. And by outsourcing our stuff so much, if we want to bring some of that back, we build the facilities, but we also have to make sure that they all have sufficient power. And of course, in the current environment, there's not in my backyard. It's hard to get things permitted, right? It's very material intensive. It has certain environmental impacts if you want to just build new transmission lines and new production, energy production facilities. And then two, when you get into the human capital, right? So, certain countries build up expertise. So Silicon Valley has built up expertise in software. New York has built up expertise in finance. So, I mean, it's also like, it's monopoly, but that's where expertise builds up. There's certain parts of Germany that build up expertise in car manufacturing.
Mhm.
Certain parts of France build up expertise in winemaking. And China has built up a massive expertise in industrial manufacturing. So their workers, their managers, there's just, millions and millions of people there that are highly skilled and experienced in manufacturing.
Mhm.
And the United States, because we've generally de-emphasized manufacturing over the past 20, 30 years, of course, we still have very skilled workers, but in terms of quantity, we don't have enough.
Mhm.
And so we've seen cases where, say, Craftsman decides to build this highly automated facility and like it runs into all sorts of problems. Or Taiwan Semiconductor, they're saying, okay, we want to diversify, we want to build in the United States, and we're being given tax credits to do so. And they have to delay their facility opening because they're saying we literally don't have the right personnel to run it. We built the shell of this manufacturing facility, but in terms of installing and operating this highly complex equipment, we literally have trouble finding employees to do that.
Mhm.
And because we've gutted some of this, you can call it human capital,
Mhm.
right? When you build up expertise, you build up human capital, at least in a certain area. And our human capital in the United States is, it's in finance, it's in tech, it's like software, it's in healthcare. It's we have certain areas of tons of capital, and industrial manufacturing is just one of the ones where we've we've not used that muscle enough, and so we've lost part of it. It takes a lot of time and effort to get that back.
Mm-hmm. Yeah, it's a really interesting problem to consider. And, as part of that article, you're writing about the advance of the advance and increase of the shale oil production in the US that really helped, dampen a lot of, let's say, the inflationary forces that would have come from energy. But if we have, you know, just for a thought experiment, if we have hit the peak shale oil top here in the US, is that also going to pose a bigger challenge to this reshoring effort as well?
Yes, it will, but I think more broadly, it's partially about reshoring and it's also about inflation in general. So when you look at the 1970s, we talked about the sources of money creation, but like I said before, U.S. conventional oil production peaked in 1970 and rolled over. So for 100 years, from the late 1800s all the way up to 1970, it was pretty much increasing almost every year, and then it rolled over. We basically ran out of our, we still had oil, but our ability to increase oil production each year diminished, and so it became more reliant on imports, and that was inflationary for us, especially when we had lots of money creation and geopolitical issues. Now the new technologies and cheap financing for shale oil allowed us to fix some of that. So if you look at the past decade, the vast majority of the world's new oil production was in U.S. shale. So a lot of other places stayed pretty static in terms of their overall oil production, whereas the United States increased massively. And the challenge is that a lot of that low-hanging fruit has been picked. In addition, the financing situation changed. So a lot of that growth was unprofitable growth. So a lot of external capital would just keep buying the bonds and keep buying the equity and keep it going. But now, because people are tired of losing money, and also there's various ESG divesting, mandates, there's not a lot of external capital for the energy space. So they're generally being more constrained with their production. If they're financing production out of their profits and emphasizing being profitable. And so it's harder to keep growing U.S. shale oil at the rate we have. Maybe we've reached a mildly higher level than, a high water mark, but the idea that just oil production just keeps going up and up and up and up is unlikely. Eventually you kind of run into a peak, and we're kind of seeing early signs of that, where well depletion is accelerating. And what makes shale oil different than conventional oil is that you're able to get it online quicker, but it also depletes quicker. So you have to constantly put more money and work into the ground in order to keep even just maintaining the production you have. Mm-hmm. And so while I don't think obviously that shale oil is going away anytime soon, I think the rate of change that we saw over the past decade is behind us now. Mm-hmm. And so when we look around the world and we see, okay, India continues to develop, they want more oil. Where are they going to basically multiple different markets, right? As they want more energy, the question is, where is that energy going to come from? And I think that the answer to that, there's still more sources to get energy, but it's not trivial, and it's probably going to require incentive, like higher prices are going to have to incentivize that new types of production to come online, mm-hmm. which is why I generally think that, this past 15 years has been like a commodity bear market. I think going forward, we're in a more commodity bull market type of environment, especially for energy, because we've generally, we've reached the end of a certain era. There's certain areas we've underinvested in, and to the extent that we want to have more industrial policy, or the world's a more complex place, or we've already kind of maximized shale, there's going to have to be more conventional oil pricing, more production, and that's going to require higher prices.
Mm-hmm. So as we're on this topic of inflation, and let's say specifically the inflation of the money supply, is the scarcity of gold and, let's say, the inflation rate of gold, looking at it from, let's say, a non-speculative, non-BRICS, major shock to the system, just looking at it from an inflationary growth perspective of this, let's say, 1.5% growth in the supply of gold per year versus the 7% let's say, average growth of the US money supply per year. Is that what makes gold so attractive to hold in an environment like this?
Yeah, historically over the past century, that's been the answer. Generally, if you take the U.S. money supply growth and you subtract the annual gold supply growth, you generally get the answer for what has gold appreciated over the past century per year on average. That differential. Now, obviously, every year it's not going to be that smooth. There's gonna be a decade where gold is flat. People are they're distracted elsewhere, and then it kind of all catches up at once in another decade. Right. That's generally how we've seen gold operate. But on a long-term basis, that generally tends to be the case.
Mhm.
The one challenge to think of is that you have to look at the different things that people can store value in. So you have to say, okay, there's gold, there's real estate, there's Bitcoin, there's art. So you kind of look at that whole market and you say, okay, that market is likely to kind of grow in line with money supply over the long run. And then the question is, among those different competing assets, which ones are going to eat into market share of others, right? Is something going to get more people interested in gold? Is something going to get more people interested in Bitcoin? Is something going to get people more interested in focusing on real estate? If and you can make different arguments as to why. If India's GDP doubles, culturally they very much like precious metals. They have a long track record of that. They're going to probably want more precious metals.
Mhm.
On the other hand, if Bitcoin continues to grow at the rate of it generally has, it clearly is chipping into some demand for gold and silver, because now as a capital allocator, you know, pre-Bitcoin, I'd have gold and silver. Now I can say, okay, well, gold, silver, and Bitcoin, right? And so what percentage do I want to have in either? So it kind of fractures the market share a little bit. But in
Right.
general, I think that's the way of thinking of it, is comparing those different supply growth rates and then determining among those tight supply things, what is more attractive. And as an example, to use a company, both Apple and IBM have reduced their number of shares over the past 10 years. These are outright deflationary assets. And Apple appreciated a lot more, whereas IBM's been a terrible investment. And it's because IBM is losing market share. Their ecosystem is deteriorating, whereas Apple's ecosystem has gotten stronger over that period. So it's not just the supply of something, it's the supply combined with its inherent desirability versus competing assets of its category.
So, I was reading through your one of your articles or your monthly newsletter, Lynn, and you said you're bullish on Bitcoin for a 2-year plus time frame. So why do you put that particular time frame on it?
So generally speaking, in the next 2 years, most of the on-chain indicators look very attractive for Bitcoin. They look similar to how you look after a major bottom, like the big bottoms it has like every 4 years or so.
Mhm.
There's a supply flow halving coming up. Um, the again, the on-chain indicators, like the supply side is very tight, meaning that the percentage of coins. So during a bull market, a lot of long-term holders sell some of their coins into the bull market as new entrants come in. And then during bear markets, a lot of these kind of like fast money people get out. And a lot of these long-term holders reaccumulate coins.
Mm.
And so a lot of coins get held by very tight hands that really know what they're holding and don't plan to give it up unless they have a massive price increase. And so generally you kind of run out of sellers, and there are people still buying, and that kind of sparks the next bull run.
Mhm.
In addition, I expect the next 2 years. So we've had falling liquidity, falling, say, economic deceleration, so PMIs and things like that. Generally, Bitcoin is correlated with liquidity and PMIs. And so I expect the next 2 years, we're probably going to have another upswing in those. So we have a combination of very tight on-chain dynamics and then another liquidity or reacceleration cycle. I don't think we're there yet, but when we look out to say 2025, um, I think we're probably going to be due for another Bitcoin bull run. I mean, that's subject to various things that, liquidity crises or geopolitical issues or things that could derail it. But that would be my base case, is that I think we're in that more attractive phase of the Bitcoin cycle.
Yeah, it's interesting just to think at it from a cyclical perspective. And if we can look back with, again, history as a guide, at least, I think that makes a lot of sense to be looking at it if as an asset, regardless of what you think about it, just from a cycling point of view like that.
Yes.
So, Lyn, I think that's a pretty good place to wrap up today's conversation. Do you have anything else that you'd like to, or that's on your mind before we do?
So I think we covered a lot. I think this environment is very complex, right? And so no person giving interviews or writing articles or anything like that is going to know everything that's going to happen.
Mhm.
And in fact, anyone who kind of claims or shows overconfidence you should be skeptical of them. This is a history rhymes, but it doesn't repeat exactly. So we have a lot of you know tools of history we can use to figure out what's going to happen. Um, Going forward, we have the combination of drawing from that history and then reasoning through the new variables that are present in the current time and the near future, and trying to figure out what's going to happen. So I think that going forward, you want to be somewhat diversified. You want to be humble. You want your mind to be able to be flexible to change as the data changes, to try to navigate what is a pretty historic environment. I think that everybody thinks they live in interesting times. There's always like the present moment seems like the craziest moment,
Mhm.
but when you look back in history, I mean, there's no doubt that the 1940s were more interesting, for lack of a better word, than the 1950s, right? And it's like it's worse, but it's like more history books are written on the 40s than the 50s for a reason. Um, and I think that this kind of era is a historically interesting period in the sense that there's major cycles or major trends or major kind of geopolitical orders that get disrupted. When you've had a 40-year period of rising debt and falling interest rates, and then the interest rate component changes, that's a notable trend change, right? That's a new variable to consider, and so I think this is just a very complex environment to navigate, and you have to be careful, and you have to kind of move forward as best you can.
Mhm. Tell us a little bit about your book that is going to be coming out here, Lyn. What is the subject of it, and when can we get it?
So the title is called Broken Money, and it's a book that focuses on monetary technology and how different technology changes how we use money and interact with money over time, and how it changes the power structure of society. So in a couple of weeks it'll be out. You can buy it on Amazon, Broken Money. And what it does is it covers, how money developed, how the current financial system works, and then various directions we seem to be going in, right? So it talks about CBDCs, and I'm not a I generally have a critical view of them. So I kind of talk about what they're trying to do, what the downsides are. I look at stable coins, I look at Bitcoin, I look at, kind of these monetary technologies that are kind of been emerging lately. So it's kind of this it's past, present, and future of different types of monies and different types of pros and cons of money and different types of how we interact with those monies.
And you shared with me as well that your editor was actually a monetary historian that helped kind of, let's say, give you a second pass filter, and it was a real asset when writing the book, right?
Yeah, my editor, Joachim Book, his last name is actually Book, which is interesting. But yeah, he has a master's in financial history from Oxford, and so he was invaluable for fact checking a lot of my research. So a lot of everything in the book had to basically get past my filter and then also his filter. And so it's been super. It's been a very, like I set out, like I already knew mostly what I was going to write, and it's based on writing and research I've been doing for years. But when you really dig into details, you find various rabbit holes, and you learn a lot more about certain nuances. So it's like they say, like if you want to learn, teach. Well, another way of doing it is if you want to learn something, write a book on it, because even if you thought you knew certain things about that subject, you're going to learn a lot more when you sit down and actually cross your T's and dot your I's and go down the rabbit holes of the thing you're exploring. So if anyone wants a really deep but accessible understanding of what money is, uh, what the current problems with money are, and then specifically how we got to the current era of money, I think you'll find Broken Money to be interesting.
Awesome. Well, we look forward to being able to get it, Lyn. Of course, all your articles that we kind of base today's discussion around are available at lynalden.com, and your Twitter handle at Lyn Alden Contact. Great resource for a lot of that stuff as well. Lyn, thanks so much for your time today. Really appreciate it.
Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.